Catherine, g'day. Good to see you.
Thanks, Greg. Good to see you too.
I was just reading your latest monthly issue of Cycles, Trends and Forecasts, and I was that impressed that I thought we should get on camera and have a more detailed chat about it, because as I was reading through it, I had a number of questions. I thought it was really interesting, especially how we go back quite a few decades with the real estate cycle and match it up to how things are going at the moment. And I thought maybe some of the questions that I would have would be similar thoughts to subscribers who have read it. If you haven't read it, I would recommend that you give it a quick read before listening to this conversation. And if you are listening to this conversation and you're not a subscriber to Cycles, Trends and Forecasts, I would certainly recommend you do so. So let's get into it. The issue was about a bloke called Roy Wenzlick. Do you want to give us a bit of info about him? Because he's quite an obscure guy, right? But a very important guy when it comes to the real estate cycle.
Yeah, it's interesting because I feel like I've known about Roy Wenzlick for a long time, but I've never really investigated what's around online about him. And he's not got a Wikipedia page, and there's such minimal information about his life that in order to find out anything, you've really got to go to the source where all his files are kept, which is the Historical Society of Missouri. And actually, I hope I've got that. I hope I've got that right.
Well, he was a St. Louis boy, right?
St. Louis, yeah, that's right. Yeah, sorry, I was just thinking to myself, I just had a brain blank, and I hope I've got the name of the society that's kind of like holding all his research. But that's
you actually went to them directly, right, to get a lot of this information?
Yeah, I went to them directly because at Prosper we've got like a whole library of information at Prosper, and we don't have a lot. You know, we have to go and source information if we want to get historical information to put into our library. And Roy, he was a real estate man. And people know about Homer Hoyt. So anybody who's a subscriber to Cycles, Trends and Forecasts, you'll know who Homer Hoyt is. We've spoken about him a lot. He wrote 100 Years of Land Values in Chicago. And he was said to have been the first to discover this 18-year cycle. But of course, the book was very focused on Chicago, and he became a very prominent figure. So he was responsible for a lot of planning innovations. And he was actually responsible for the redlining that went on in the US. So the distinction between where black people lived and where white people lived was actually down to him. So he's quite a controversial figure, but he's well known, and he's got a big Wikipedia page, and you can find all sorts of information about him, and you can find his book free online. But Roy Wenzlick, who perhaps contributed more to the research behind the 18-year cycle than, anybody else through the period of his life, is kind of written out of history in a way, unless you go searching for him. So in the 1930s, 1936, he wrote a book called The Coming Boom in Real Estate and What to Do About It. And it was kind of like a pamphlet. They would produce a lot of pamphlets at the time. So it wasn't kind of like a big, weighty, heavy book or anything, but 100,000 copies were sold. It became a New York Times bestseller. And it was interesting because it was in the middle of the Great Depression when he wrote it. So the property values bottomed in 1933. And then in 1936, out comes this book saying real estate's going to boom. And this is why I'm telling you that it's going to happen. And this is how it's going to happen. And it was published by Simon & Schuster. And the publishers have this big forward in the book where they say, we were being asked all these questions about where, should we sell? Is it time to buy? What's going to happen to real estate and everything? And the Depression was just, I started actually the edition, the monthly edition, just putting a little bit about how bad the 1930s Depression was, because I feel like everyone knows it as the Great Depression, but it's difficult to kind of conceive now with what we go through now as to what they were going through then. And it really was just such a desperate time. And there was a lot of blame and a lot of inquiry as to why has this happened, and there's some people were saying it's the sins of the nation as to why it's happened, because it came after the Roaring Twenties and people were selling their cars, and they were, we were so excessive in the period of the 1920s, and now here we are. And so there was a lot of inquiry at that point going on as to what has happened, why has this been caused? And of course, Roy Wenzlick was somebody who was already prominent in looking at real estate values. I mean, his father worked in real real estate. And from an early age, he went to work in his father's company. And part of that was setting up a research department in his father's company and gathering real estate data and looking at it. So he'd been doing that for a long period of time when he came to write this book. And yeah, I mean, the book, well, I mean, you can't get it online, but it's very well researched. It's not just a spruiker coming out and saying we're going to see a boom in real estate, like you see now with the, your spruikers coming out on your Instagram feed or anything, telling you why real estate's going to boom and why interest rates aren't going to crash real estate. I mean, it was very detailed and very well reasoned throughout the book, and probably that's why it was such a bestseller. And
there was actual science behind it, right? There was properly backed up.
It was clear that he was, well, I mean, it had all these charts in, and so he had identified previous booms. He'd identified a boom in real estate values in the 1870s, in the 1890s, sort of leading into the 1900s, 1907, when they had a crash. And then, this boom kind of obviously leading into the 1930s. And then he said, well, he based all his analysis as to why that had happened in the past, was kind of put into this book, and said, well, this is why, this is going to happen now. This is why we're going to sort of forecasting now what's going to happen. And of course, it did actually happen. He'd made some correct calls a little bit earlier than that. He was already well known at this point within the real estate world. I mean, that's why the publishers approached him, because he was already known for having done a lot of analysis, and within the industry itself, he was already a sought after figure. But when his forecast started to come true, then that was when he really gained popularity. But his passion was economic forecasting. So he set up the first, the Real Estate Analyst, which was an annual publication that came out talking about where the market was going to go and why it would go there, in this kind of economic forecasting journal. And investment companies used his research, and insurance companies. So he was, he was a sought after figure kind of from that point. And his body of work is immense. When he set up his Wenzlick and Co. sort of company, they did, I think, over 400,000 appraisals. They wrote manuals on how to value property valuations, and they were involved in restoration projects, very big restoration projects in the US. He did numerous television interviews. He would go out and do these speeches, and he was a very inspiring speaker, and he was passionate about maps. In fact, you can find some of these, you can find pictures, some of the pictures of them online, because they're now collector's items. But he would draw up these big maps and these big charts, and he would take these along to his lectures and kind of unroll them and talk, to universities and to companies that were interested in this as to how to forecast real estate values. And he had all these metrics on it. But at the root of that, he had established that there was this long cycle in real estate. Now, there was a lot of analysis that was going on around this time anyway. I mean, Roy Wenzlick wasn't the only one, but he declared himself that he was the first to discover the long cycle. And he probably was. I mean, his research had started before Homer Hoyt or around started then. So he may have discovered it and how it related to the whole of the US rather than just Chicago. And
I guess the point is he discovered the same cycle independent of the, say, Homer Hoyt, who discovered a similar cycle based on his studies, right?
Well, Homer Hoyt was just looking at Chicago, and Chicago was like a rapidly developing city at the time. So it was in its early stages of development, and there was, a lot of population growth and a lot of speculation, a lot of infrastructure spending that was going on. And so it was, and actually Wenzlick makes this point in his analysis that, and we would know it now, that any city that is going through this kind of rapid gentrification, it is and undergoing speculation because of it, you're going to see real estate trends play out in that. And then there was a case where he applied it to the whole of the US, and he smoothed out the data and the fluctuations in the data to kind of identify what he said was an average of 18.3 years of this cycle. And sometimes the cycle could, be 16 years, and sometimes it could be a little bit longer than 18 years. So it could be up to 20 years. But on average, it would come out at 18 years. Now, I know from subscribers that we talk so, distinctly about, well, we're heading up to 2026 and this is the date and it's the 18-year cycle. And I think the point that he was trying to make was that it's not that we've got the date of the 18-year cycle wrong, but it was just that there were periods through the periods of history that he was looking at where the real estate cycle could peak a little bit early, then that 18-year downturn, or could peak a little bit later. But ultimately, when you're timing the crash, we obviously look at the stock market and everything else sort of to do with that. But it wasn't saying that there was a massive crash on 16 years or a massive crash on 20 years. But it was understood that there could be, it wasn't exactly 18 years. And he really wanted to make, pains to kind of say that. And then he would use his analysis, like the analysis of the, of the barometers that he was looking at in the real estate market to kind of accurately time when those booms would occur and when real estate would have topped out, so that he could advise people as to what to do. And he was he was teaching people how to profit from the real estate cycle. He did understand, the economics of the time. Henry George was obviously a very prominent figure at that time as well. And regular subscribers of CT&F will understand who Henry George was. And he came out early on and said, the only way we're going to stop a boom in real estate is to tax land, is to take speculation out of the real estate market. Let's tax land. Let's tax what you don't earn, because land goes up in value, not because of anything that you do. And let's remove taxes off income and productivity. And so that was kind of Henry George's stance. And Wenzlick, whilst he didn't, he would never have been called a Georgist as such. There are articles where he kind of supports that way and says that there's a...
I was going to ask you about that because from what I understand of the cycle, the driving force is that Georgist view that because land is not taxed, it creates the cycle via the speculation, via the adding of infrastructure into the land and all those sorts of things. Whereas reading through this issue, it seems like Roy Wenzlick had got to the same conclusion but from a different angle. So, and perhaps we can go through some of this stuff. But there's an interesting bit that you wrote here in the issue, and it says, importantly, we mean Wenzlick's analysis is going to assist you in gaining a deeper understanding of the trends that drive the 18-year real estate cycle, and it will help explain why we're not likely to see a crash right now. So, from what I can see, Wenzlick didn't really talk much about the taxation aspect of land or the non-taxation aspect of land, but he came at it really from like fundamentals like construction costs, family formation, those sorts of things. Do you want to maybe talk a little bit about that?
Yeah, so I mean, he understood the taxation affected property values, so he did look at that, but and did understand how that could dim the cycle. And there's a newspaper article that's sort of out there where he was saying that he supported that perhaps they could tax land in order to employ land into use and not have it held for speculation. But what he was really looking at was he was saying that in the short term the market was affected by supply and demand. And if you look at when I was writing this article, it was actually really difficult to write, because I thought, well, I've got to write something. I'd put a weekly out and I mentioned Roy Wenzlick, and then I got a few people kind of writing to me who it's clear that not many people knew about him, and I just had assumed that they did. And I was thinking, I've just got all this body of work of his. How am I going to sort of
put it all together now?
Like how he analysed the market, because there were, like a lot of things that he did look at. But the way that you can kind of do it, and he says this himself several times in several pieces of writing, that in the short term he looks at the supply and the demand, and because the supply and demand is affected by numerous things. So it's affected by one of his favourite things was to look at marriages, because he recognised that the marriage rate would go down in depressions because people get married when they can afford to, and obviously in that time they were getting married and then probably going on to have children as well. So it would go down in depressions, and then once you started to see that there was a fluctuation in the marriage rate, which was quite wide, that more people would get married and then they would move out and they would want more properties. And then it would be, there's a sudden shortage of properties. So that was kind of one of the things. And then he would look at infrastructure and where the infrastructure was being built. And so he understood that caused a boom in land values. But over the longer term, he was very focused on construction costs. And he felt that this had been something that he had monitored historically when he'd looked at the booms that had happened. And he was saying that, as construction costs rise, as it becomes more costly to replace a house, the existing housing is going to take some of that increase. Because if you logically think about it, and we're seeing it today in the market, is that when it becomes very expensive to renovate a house, to build a house, so construction and labor costs, the price of existing homes that are on the market start to take those gains because there is a shortage. I mean, what are we listening to now on the news and in the media is that rents are in the stratosphere, and they're going up over 10% a year. I mean, that's nationally. In certain areas, it's much, much more than that. And there's not enough properties being built, and we've got a shortage of skilled labor. So we've got the Jobs Summit, and we've got these problems with shipments and construction costs. And so for the buyers that are in the market, then that is pushing up the price of existing properties, and nobody's going out there and building. They're focusing more on what's a good property I can buy and what is, a renovated property that I can buy.
So that's a really interesting aspect of it, right? Because a lot of people will think that the main driver of the property market or the property cycle is interest rates, right? And we just saw an interest rate rise in early September, just this week. We're recording this on Thursday, the 8th. Of September. So on Tuesday, the RBA put up interest rates again, and the whole commentary and the whole sort of idea is that as interest rates go up, it's going to put pressure on house prices. But what we know from the cycle is that rising costs of finance will put pressure on the value of the land, but the things that you're just talking about, the rising cost of materials, the rising cost of labor, puts upward pressure on the price of the physical dwelling. So how do you think about those two things in a rising interest rate environment, which is affecting the capital value of the land, versus the rising inflationary period, which the interest rates are trying to deal with, that pushes up the price of construction? How do those two sort of counter actions play out?
It still is the fact that, you're looking at, it's the land and the location that count, obviously that's where they can't depreciate, and the building on top depreciates. So we talk about that all the time. But ultimately, your property is only worth what a future buyer is going to pay. If you get your property valued for a bank loan, they're valuing against comparable sales, which is based on what a buyer is going to pay. And so when I talk to buyers, I would say, you've got to focus on a property that is appealing to a broad demographic of buyers, because the more, if you've got investors that are interested, maybe developers, depending where we are in the cycle, family home buyers are very important because they're our biggest buying demographic. Then you've got 3 or 4, like demographics that are going to be interested, whether we're in a soft market or a hot market. So the property does matter that's on the land. And what's happening now is that if you're in the market to buy properties that actually need a lot of renovation, or raw land, or land that has got plans and permits, it's not that the value has gone away. It's just that a buyer needs to be able to, they've either got to buy it and sit on it and not get any yield on it because there's no house on it, buy it and build on it, which there's no kind of profit in doing that because they can't access the building supply materials and or the labor costs. And so those items go down in value. Now, the actual long-term value of them, I mean, if you're going to say, well, you own a really good piece of real estate in a really good location, but it's not got a great house on and it needs work and everything, and it's suffering in this market because of what's going on. Long-term, it will, the cycle will go through and the locational value will, kind of catch up when we get through that point of the cycle. But the other thing to bear in mind, and I've said this numerous times in publications, is that we always get rising interest rates alongside, we always get that inflationary pressure alongside rising prices in the second half of the cycle. That's a very common phenomenon. And in the publication, Wenzlick points it out himself. He looks historically and he says, yeah, this is what's happened historically. And so, this is why you're seeing the price of existing land rise. And then you have all the other drivers. I mean, land, ultimately, the real estate market, in an environment like we've got now, is subject to speculation because the tax system dictates how investors are going to invest. And we don't tax properties highly compared to what we do to income tax and productivity taxes. So property is still seen as a hedge against that, if you like. And so, it's driven by speculation. It's driven by by investors saying, well, we're not getting a great yield at the moment elsewhere. We'll go and buy a property because rents are going crazy. And, in the rent can cover the interest payments or whatever. But in Queensland, that's changing their tax system at the moment. I don't know whether you've heard about this, but again, I've had subscribers write to me about it. What Queensland are doing is they're shutting off a loophole in the land tax system. So what has traditionally been done in Australia is that investors have bought land in various states to take advantage of the land tax threshold. Right, so a certain proportion of the cost that you pay on the property is not taxed if the property falls, it's not subject to land tax. And now Queensland is saying, well, we're going to take away that tax-free threshold. So if you own land outside of Queensland and you own land in Queensland, we will take into consideration all the land that you own, and then that will push you into a higher tax bracket in Queensland, and you won't be able to advantage from that. And of course, that is pulling investors out of Queensland. There's investors thinking, well, unless they're just going to invest in Queensland, they're thinking, well, maybe that's not a great place to invest. So the tax system and the localized nature of what we go through locally in Australia, of course, is going to have minor effects on the cycle. But the major downturn is always going to come at that timing point. And that was obviously what kind of sat at the back of Wenzlick's analysis. He realized, for example, this is actually why you get the skyscraper boom as well, is because skyscrapers take such a long period of time to build. They're planned and everything when easy money is around. And, and then there's like a 4 or 5 year period from concept to completion, and then once they're completed and they're about to be go through, be opened, and they all tend to go up in clusters. Of course, you've kind of hit the downturn and they open empty. But
so just on that, is there
do matter?
I was going to say we're coming into 2023, not just yet, but getting towards the end of 22 into 23. The skyscraper index, that's not saying there's a peak, there's a bust coming in 23. And I asked this question because at the moment in the media, there's a lot of negativity around property market. And because interest rates are going up, everyone thinks property's going to crash. And, there's people out there writing that, Sydney's falling at annual 30% rate, or, biggest busts or biggest downturn since the 90s. But using Wenzlick's analysis here and based on your knowledge of the cycle, you're saying that there's not going to be a crash, and that's really based on the supply and demand factors that we're talking about, the fact that rents are going up because there's still a lot of demand for property and the supply is just not there because of the high cost of construction. Is that a fair way to put it?
Absolutely. And obviously he also looked at population growth as well. And, we've got immigration and our borders now opening, and now there's this big push to get migrants in. And, they've raised the cap to record levels on the number of skilled migrants they want to attract. Whether they'll come is another thing, but that's where the push and the encouragement is coming from. So he would look at all of those factors, but he made a real point of saying that not many people see the real estate cycle. They don't see it because it's such a long cycle. And I mean, we know this in Australia because we had a very soft downturn in 2008. Actually, it was quite harsh if you worked in the real estate industry, which I did at the time. But, and then, of course, the last crash was in 1991, but it didn't affect Brisbane as much as it affected Melbourne, and it didn't affect residential property as much as it affected commercial property, but it's still very, it's still a recession and a downturn. So, I mean, I think part of that is because Australia is a small country and we have had a rapid population growth at times. And we've been the lucky country in terms of our mining and everything. Obviously, when you're looking at in Europe and America, it's been a different story. But he made this point of saying this is a long cycle. And many men won't have been in business for the length of a cycle. And so you can't see it. And the only way that you're going to be able to see this, and I think I put this quote in the article, is if you look historically at what's happened in the past. And that's what he had done. And he said, I'm the first person to have gone back and done this. You know, he said, I've gone back and I've collected all this data from, you know, the time in the Civil War and everything. And I've got all this data and I've looked at it and I've identified these long waves. And
I like what he said about it then, because I've got the quote here. And he said, they are the common sense interpretations of hundreds of charts and studies showing real estate fluctuations and their causes in these periods in the past. We believe that anyone with average intelligence would have reached the same conclusions from the same studies. So he's basically saying, if you got the information, it's pretty easy to see. But when you're down in the weeds on a daily basis, it's almost impossible to see.
And he also has this bit, you know, kind of like he wrote this book, you know, Inflation in Real Estate. And there's this preface at the beginning of the book where he talks about fortune tellers and he kind of says, you know, we've got all these astrologers that make these predictions and everything, and how he gets kind of bungled into this mix of people and the criticism, and I put this in the article as well, the criticism that was levied at Wenzlick really came from his cyclical analysis. And the real estate industry and anybody who had connections to the real estate industry didn't want to recognize that there was a cycle. And, you know, they wanted to, and I think that that's the atmosphere that we sit in now. I mean, when you listen to certain commentators talk about we're going to have a 15 to 20% drop, and we had Chris Joy do it, Shane Oliver, I was writing an article yesterday and quoting him, and he says, yeah, well, from peak to trough, it's going to go down 15%. Now they're saying that the medium, the national medium is going to go down 15 to 20%. And I can tell you that the national medium has not gone down 15 to 20%. Well, certainly in any, we talk about that we correlate with the last 3 real estate cycles, because that's really where, you know, international borders open and there's a lot more speculation going on and a lot more cross flows in finance, you know, international investment in Australia. So we correlate with those cycles. Now, at no point in any of those 3 cycles has the national medium gone down 15 to 20%. And those cycles have covered periods where inflation has been extremely high, and in periods where it's been very low.
So you're saying that people need to take advantage of that fear if they're thinking about buying, and just buy rather than be worried that they're buying into a market that's going to continue falling?
Yeah, I feel that, you know, obviously none of us know what's going to happen tomorrow. You know, I'm not psychic. I can't tell you, you know, what your day is going to be like or anything like that. We're looking at it from a historical perspective and from a cyclical perspective, because no one else is looking at it from a cyclical perspective. And then obviously I've got the advantage of also working on the ground. I work in the real estate industry and I'm seeing what's going on. And I know the indicators, I've known them for a long time, of what the leading indicators are of any kind of change in the market. And so I'm listening to, I know Sydney's having a hard time, but let's face it, Sydney does kind of tend to peak a little bit earlier in the cycle. It did in the last cycle in 2004. It peaked and then it didn't go anywhere until 2008. You know, I mean, it just kind of plateaued earlier in the cycle, and Sydney's going through a bit of a hard time. But it's a very unique market. It's a very expensive market, and it's a very centralized market. But in the rest of Australia, so say Melbourne, which is a city which tends to boom and bust with the cycle. So it has a strong run in the first half, and traditionally it has a strong run in the second half as well. It's actually not bad out there. The clearance rate, which is a leading indicator of median price changes, that's why I monitor it, not because I don't think that I always get a lot of criticism whenever I tweet out the clearance rate. I get a lot of people saying, oh, it's not accurate, you know, it's just inaccurate. It does not matter how you feel about it, whether you think it's inaccurate or not, whether the agents are reporting the data or not. It has historically, those clearance rates have shown when there's going to be they kind of represent the heat of the market on the ground. And if the clearance rate is going up, then normally at some point you're going to get an upward beat in the median price. And the clearance rate at the moment is pushing in on the prelims before it's been revised into around 60%, which kind of shows a market that's leveling out. So that's vendors that are primarily meeting the market. So they're discounting, but they're meeting the market, they're turning over. And there's a lot of buyers out there. And the reason that there's buyers out there is because the rental market's very tight. Buyers can access finance. They just can't access as much as they were. So we've got, and they can access finance because we've got record low unemployment. We've got job shortage, which is why we've got the jobs and skills shortage going on. And interest rates historically are still very low.
So what in a very bearish market, the clearance rate is what, somewhere around 50% or lower?
Yeah, it goes lower. I mean, it goes into like the 40% mark. I mean, it didn't really count when we were in lockdown because nothing could really be auctioned and the market kind of went behind closed doors and there were a lot of private sales. But the clearance rate is it's actually a very small proportion of the market. Only around 20 to 25% of Melbourne's market goes to auction. The rest of it all happens private sale. So the total value of property being sold is another indicator that we look at. And I mentioned that in the article because that's the indicator that we use at Prosper for the Cavanagh-Putnam Index. And that gives us a very long lead as to when there's going to be a recession. It's never been wrong. It's when the number of transactions fall markedly. It's not there right now, and they kind of fall below this level, and then we know in kind of 12 to 18 months that a recession is going to follow. So that's the health of the market. The number of properties turning over is important, but right now, the clearance rate, when it's very low, the market is going down. When it gets into around the 60% mark, then you're normally seeing on good volumes, then you're normally seeing a leveling out. And then when it gets to the 70, 80, then the market's, the medium is usually going up. Yeah, I mean, look, I think that the looking at the interest rates alone and trying to calculate, just looking at interest rates, how far the market is going to fall based on a percentage move in interest rates is flawed if you look at it historically, because historically interest rates, there have been many periods where interest rates have risen alongside property prices. And this was Wenzlick's point when he got criticism from the real estate industry. He said, first of all, he got criticism from the real estate industry primarily when he was saying we've got to the peak and now real estate's going to go down, because nobody working in real estate wants to say that the real estate market is going to go down. But he got criticism from a number of people that said, well, you believe in cycles. It's just ridiculous. You might as well believe that caterpillars and I don't know what the other animals.
Yeah, it was a funny quote.
That was right. That affect our lives, that they affect our lives, that what their movements are affect what we're doing. But that's the whole point of looking at, this is the whole point of the stuff that I write in CT&F when we look at, I did that publication on the oldest housing index in the world, which runs down one of the canals in Amsterdam, saying that you can trace the cycle on this. We can, when you've got long-term housing data and real estate data, you can trace this long cycle on it. You can trace it in the stock market as well, which is why the stock market has always been known to have these kind of 17-year cycles. There were many other people that looked at the real estate cycle. Clarence Long was one of them, who was a US politician. And in 1940, he looked at it based on construction. So he identified a construction cycle that was about 17 years long. And it was named the long cycle after him. And I've got his paper, he wrote a very long paper on it. But there were numerous other people that did investigation around this time, all academically, kind of all locked in academic circles. I think Roy Wenzlick was so unique because he really commercialized it. He was telling banks and insurance companies and real estate investors and home buyers, he was giving them advice on what to do to take advantage of values going up or values crashing. So he was that was the uniqueness of him. But he's not given it's kind of been written out of
Well, I was going to say, I thank you for bringing him to light, because it's a really interesting read, and I'd encourage anyone to have a look at it. There's lots to learn from it. And, just to say, I think you're doing awesome work with Cycles, Trends and Forecasts. There's nowhere else in Australia that subscribers and members are getting this information. And I think in a environment or an era where we're so fed with fear and greed headlines all the time, especially when it comes to property, to have someone really sitting up high and looking at these long-term cycles is a really valuable thing. So, so thank you very much for all the research and the work you do. I think it's awesome, and very proud to be publishing such good work. So nice work.
Yeah, thanks. And that I absolutely love doing it. I love doing it. I love the interaction I have with subscribers, and Yeah, and you know, for anyone listening, I always love your feedback and to give me feedback and help me make the publication better and more tuned into what you actually want. So it's a lot of fun doing it. I really enjoy it.
All right, we'll keep the questions coming, and thanks again for joining us today, and we'll catch up again soon.
Beautiful. Thanks, Greg.